Canada is number three in terms of the best place to find natural resources. And there is an incredible amount of opportunity in Canada. And one of the great ways to do that is through the Pavilion Flow Through Share Funds. It's an amazing opportunity to take advantage of fantastic tax savings and incredible investment opportunities. Join me today as I talk to their founder, president, and lead portfolio manager, Dan Pembleton. Hey, welcome back to Money Match. It's Ian Ardill. We're matching up your money with your life goals. We're talking today to Dan Pembleton. Dan is one of the most interesting guys I know when it comes to mining and ultimately natural resources. Dan, welcome to the show.
Thank you for having me and appreciate it being here.
Dan, I'm so thrilled that you took the time to hang out with us here on the podcast. Dan, for those that don't know you, tell me a little bit about who is Dan? Where do you live? What do you do for fun?
Sure. Well, I currently divide my time between Oakville, Ontario, and Vancouver, BC. For fun, I play with my dog and walk around looking at mountains and the sea and generally getting outside. So it's been a nice transition. I'm originally an Ontario only guy and grew up in Ingersoll, Ontario. So in the middle of southern Ontario farm country. So
I love Ingersoll. It's a beautiful community. But Vancouver is a very different community than Ingersoll.
Yes, yeah, much, yeah, and no slight against small towns or Ingersoll specifically, but I definitely enjoy Vancouver very much.
Yeah, I was talking to one of my clients on Vancouver Island yesterday, and they live on the more northern section. They're about an hour and a half north of Nanaimo, and so they're close to the ski hills, close to the water for surfing. They're like kind of right into the action. And I said, I've got serious FOMO. My family, my business, everything is in Ontario, but if I was to pick anywhere in Canada to live, I probably would end up on the West Coast. But again, no insult intended for anybody living anywhere else in Canada, because I've got great friends and family right across the country. Dan, tell me a little bit about what made you get excited about finance. Like you've shared with me previously that you got into finance at a really early age. What was the driver for you? What made you interested in getting into finance, and where did that lead you ultimately?
I think, I got interested in finance. I think my first financial analyst work I did is, and good to see you're sitting down, I did a report, I think in grade 6 on gold. And that would have been around 1979. I think I was 12 years old. I don't know how old you are in grade 6. Maybe I've got the grades wrong, but that was my first analyst gig.
Wow.
Yeah. So we've come full circle. I've been thinking about that too. I'm like,
So in grade 6, you wrote a report about gold, and that and now today, and again we'll get into this a little bit later in our conversation, but you're still talking about gold.
Yeah, exactly. It's like I had better be pretty good at it by now because I mean, when you start something when you're 12, by the time you're 59, you better have learned a thing or two about it.
Well, and I got to tell you, Dan, like being 59 on the cusp of 60, you look fantastic, my friend. Like you're doing something right. Um,
Yeah. Well, hopefully, I mean, I don't know whether this is AI filtered or whether that's actually me, but it's very generous, the lighting, I think.
Dan, so talk to me about like you've spent a few years in the space. You did your undergraduate and master's degree in finance.
Hmm.
I think you went to Ivy, correct?
That's right. I did my MBA. I did my MBA at Ivy. I did an undergrad in economics and business at Brock University, and I am a CFA charter holder that I got in 1998. So,
So
yeah,
you've been in
yeah,
the industry for a few years.
yeah, a couple. Yeah, yeah.
So you've spent your entire professional career in the industry. Started, why don't you talk to us a little bit about where you started, and then kind of, and where do you find yourself today in terms of your primary role?
Sure. I started out in on the bond side, and my first job was with RBC Dominion Securities, and I was a bond trader, institutional bond trader with them for nearly a decade, and then after RBC, I went and did open outcry futures trading in Montreal. That was for my what's called your own book, so it was my own money, and did that, and then decided that I would start my own firm, and I wanted to. What I saw an opportunity there to take things that I had learned along the way and apply these investment ideas and techniques that I learned institutionally, apply them to funds or products that are available for a broader community into the retail market. So that's where I positioned myself from there. And now, around in 2008, actually, I created sort of our main fund that I run to this day, and my responsibilities are for obviously running the company, but also directing the investment activities for Pavilion Flow Through Fund.
Pavilion, I'm wondering if you can highlight for us. You hold two records that I like bragging about when I talk to clients about you. Can you tell me about your two records that you have with Pavilion?
Sure, and I mean these are always to the best of our knowledge because we don't know everybody, but on the research that we've had, we hold the highest single returning flow through for a flow through fund, so highest total return, and also the longest running return for flow through funds, so consecutive years, measured again, measured as a person at the top marginal tax rate in Ontario. So yeah.
Thank you, Dan. Yeah, that's impressive. What that means is you've been in this space for a while, and you know what the heck you're doing. So it's great. We're going to talk a little bit more about that in a moment, but wondering if we can kind of jump into that hard asset conversation of ultimately Pavilion is an investment in hard assets, and you really like hard assets for a
Mm-hmm.
number of reasons. I'm wondering if you can give us a more global view of what's going on in the global economy right now. Like as we record this, it's spring 2026, and as we look out to the future, hence the future markets. And we look at what's going to happen in the next 5 to 10 years. There's some interesting things afoot. And I'm wondering if you can talk to us about that and why somebody might be interested in, deploying capital into real assets.
Yeah, if I had to, I mean, if I had to summarize very quickly what's going on in the global economy, I think I would just say too much debt. It's we have accumulated an enormous amount of debt globally, individual companies or countries. It's personally, this is a society that is floating on a lot of promises to repay people, and those promise to repay means that we have to pull back on either our own consumption or a country consumption in order to pay that future obligation. And right now, that looks to be getting harder and harder for people to believe that could actually happen. And what if I was to say, to highlight it, just to work with, say, the United States example, they are close to now 120% of their GDP equivalent in debt, and that's their total amount of debt. That's just on the books. There's future obligations, which actually brings that the future payment obligations, which isn't an actual current debt, just the way they keep the books, that actually doubles that number. So they have a lot of pressure on their budget, but the budget is already in deficit. So they run a 6% of GDP deficit right now. Those kinds of levels, a 6% GDP deficit, that is usually something that is only reserved in recessions. That's the kind of excess government support and spending that occurs during recessions in order to help an economy grow out of it or to catch it as it's falling. But there is no recession in the U.S. and there hasn't been since the COVID disruption, which was really a mandated response to the pandemic, very different from many recessions, but that's the last recession. And so to have this level of spending just on your everyday, it's unsustainable, for one, and it also reduces the number of options that are available when a future recession comes. So that's and so that's the background. The thing that we need to think about as investors is, really, what does this mean for me? What it means is
just trust the government and trust politicians more, right?
Well, that's what they would like you to do. And
Can we please pay more tax?
well, that's one way out of this room. They certainly, need to either, if they're going to do this, they'd either increase revenues a lot, decrease expenditures a lot, or the one that they have shown that they prefer and is the easiest to for them anyway, easiest to do because nobody sees it. It's the silent seizure of assets, which is inflate their way out of it, and that one of these, the fourth one now, which would be very obvious and very destructive, would be some kind of default on the debt. That's not really tenable. So I think what we have seen and what we are seeing is movements towards inflating inflating the way out of this bit financial problem that they've got. So it's just like a continuous eroding of the purchasing power of fiat currencies, and with the US dollar being a flagship for that, which is why, people will say when they're going through the grocery line that they've never had to fork over more dollars for so empty of a cart. And that, that is exactly what inflation does. It allows the government to keep the wheels on the bus, but it does it by really putting the bus on the backs of everybody who's working in the economy. And
again, I'm not trying to get hyper political on this call, but like I just anecdotally I saw on LinkedIn the Conservative Party put a post out, highlighting that cucumbers are up 23% year over year. So in 1 year, a cucumber cost 23% more in a single stinking year.
Yeah,
That's crazy.
and if you you extend that and you think about what education costs and housing and vehicles, it's something that people are seeing it. We're going to see more of it, is what I believe, because the only way that the government can keep its financial house standing is to have this kind of inflation continue to go on. Otherwise, there really just is no way for a country to pay back those kinds of levels of debt without some severe austerity, complete buy-in from everybody. We don't have a consensus in the political realm anywhere really to make this happen. So the inflation is the only way out of the room, is the way I see it. And hard assets are one of the ways that people can protect their wealth in this.
Well, so let's zero in on that. I thought it's interesting. There's been a major shift. I remember even as I'm a few years younger than you, Dan. And I remember in the 90s though reading about how central banks were dumping their gold reserves. Mm-hmm. And that is there's been a total inversion of this. Central banks, not all, but a lot of central banks are aggressively trying to go after gold. And so I know you're not dealing in exclusively gold, but certainly that's an asset that's been the number one on your charts in terms of asset allocation for a number of years. And I think one of the things that I find interesting is you see that as continuously something that you're chasing after. Gold is something that central banks are picking up, private citizens are picking up as as something that is providing some kind of standard hedge against inflation. And you fundamentally believe that gold prices are, even though they're at record levels, you think that they're going up still. Fair?
Yeah, I firmly, that is fair. The path of least resistance that I see for gold, precious metals, and they're just the lead on the commodity front, but I believe it will impact virtually all metals and commodities of all kinds, is the path of least resistance is higher. And the reason is, one thing to think about as to why is the scarcity value of particularly gold. But in this context, in the next 10 years, 20 trillion more dollars of US debt will be issued in the form of bonds. So you have 20 trillion of bonds that you can choose from. And about, in that same time, about 2 trillion of gold, depending on, how you assume production of gold and where you price it, but about 2 trillion worth of gold will be produced. So even in that ratio of all the gold produced versus just the U.S. debt, not including the rest of the global debt, which is, obviously
Well,
going
the
to be
nice
trillions.
thing, Canada's not producing any debt either, right?
Yeah, well, yeah. Wouldn't that be nice to say? I think we, in some ways, we are relatively better than many, but we are quickly turning the corner on catching up. This is one area where I wish we wouldn't try and catch up with the rest of the world. Our debt is, and the decisions that we're making now are going to significantly add to Canadian debt. So if you look at that from a scarcity value point of view, that gold just becomes relatively more and more scarce compared to these to paper assets that are out there, and so that also provides a propulsion to gold. And you mentioned central banks; they are very big buyers of gold. They bought about 1,000 tons a year, sometimes a little bit more, over the last 4 or 5 years, and that is central banks looking around, and they can hold U.S. dollars, they could hold euros, they can hold various currencies and bonds for their balance sheet, and many of them are choosing to hold gold as kind of the true money out there. So
The old-fashioned gold standard.
It is very much getting to look a lot like that in some countries.
I'm gonna kind of reverse course here and kind of move into a conversation around Pavilion because ultimately a lot of these drivers, these macroeconomy drivers, pushes the argument around why somebody should want to own hard assets. And you guys have been doing a marvelous job at deploying capital in the junior space. And just for listeners' sake, a senior producer versus a junior producer, there's a difference. If you drive up to a senior producer of gold, for example, they're physically pulling the stuff up out of the ground. Dan, the question is, what is a junior producer? Can you just give us a brief definition of what is a junior?
Yeah. So the junior, yeah, I would drop the producer from the name, and I would just call them juniors, and they're explorers. So I would really look at them as they're the future feedstock for the producers. So obviously in mining, you are going in and you're mining your already known resource and what you've got there, and you're pulling that out of the ground. So you're depleting your reserves by actually mining it. The mining companies need to have future mines, and they need to, obviously the global economy needs to have future mines. So it's in everybody's best interest that we do some exploration. And the juniors are out there going into the field, literally fields and forests, and they are looking for the future deposits that the producers will be mining. And in order to do that, they need to have capital, obviously, and we are one of the providers of that capital, so that they can go out and explore, hopefully find something of value, and explore some more around it and develop it so that it's bigger and attractive to become a mine in the future.
So one of the things that you guys do a fabulous job of is building out a portfolio every year. And again, we'll get into the tax mechanics in a moment, but ultimately, I'm wondering if you can elaborate and just ratify what I'm saying here. Every year, you invite investors to join in on a limited partnership basis, and you have these limited partnerships that get deployed in new portfolios every single year of different investment opportunities. And then over a 5 +1 +1 type scenario, so up to a maximum of 7 years, that capital gets deployed and a little bit of money comes off over the time period. But ultimately, what you're trying to do is you're trying to grow clients' wealth through that season in this space, using your level of expertise, using your level of insight, because this is what you guys do day in, day out. From the time you were in grade 6 all the way to being 59, you have been analyzing mining opportunities and trying to do great things for great clients, officially since 2008, right?
2008, correct. Yeah. Yeah, that is really each year is its own vintage of limited partnership. We form a portfolio in that year to carry through for 5 + 1 + 1 if needed. And our objective, we go fully invested in the first year, and then from that point in time, we then look to divest and return capital to clients over that period of time, and do hopefully a good job and get them a return, not only on that capital, but as you mentioned as well, there's a tax advantage to these funds as well.
Yeah. So, in essence, one of the things that I find, really kind of amazing in terms of returns, like net after tax, in terms of your closed end funds, the funds that you've like managed right from the beginning, right through, and now have come to a completion, they've averaged 105% return. Net after tax. Again, that's assuming a 50% tax rate, and that's a total return. That's not an annualized return. And again, I think that's incredible. Like that's a very, very attractive return to, I think, most investors. But you can pigeonhole, or you can because they're unique every year. Some years have not been strong. I think the worst performing fund you've ever had, again, past performance is no guarantee of future losses or future gains. The worst performing fund you've ever had, net after tax, was minus 21%. Nobody wants to lose 21%. The best flow through fund, I should have invested with you in 2013. I apologize. Was 386%.
Mm-hmm. Yeah.
And by the way, that one's not even done yet.
No, it's not. That one. That's been that's a very special. That is a particularly special fund, and I wouldn't want anybody to think that we will repeat that. Certainly try.
Well, that's what I'm like. Why can't we repeat that every year, Dan?
Yeah, it's like, well, because I'd be retired by now, and so there are limits. Yeah, those are the goalposts, certainly, that we've set, as I like to call them. That it's a wide range. Certainly the good numbers in when somebody looks specifically at our track record, the good numbers, and these are after tax treatments, so people should understand that there are tax benefits that are calculated in there that people got. They're real, but we have to assume a tax rate for them when they're exiting. But 50% is right around the top rate. So and these funds are most effective the higher somebody's marginal tax rate is. So they tend to get better and better as your tax rate gets higher because of the benefits of the tax. But it is our less good funds tend to have had relatively small losses, at least when you compare to what our good funds, really good funds are, which have had some pretty good. And of course, we kind of I thank you, but also it's like we only quoted the very best fund and the very worst fund. There's a lot of funds. We've done 22 or 23 in there, but they all fall between those return rates.
In the vast majority of them have been in the positive territory. Dan,
Very.
I'm wondering if we can maybe shift gears here and talk about tax, because one of the things that most people who are in the higher echelon, like of income, and I don't think it takes that much in Canada to get in the higher echelon. You know, if you're paying a marginal tax rate of 35%, you're paying a lot of tax.
Yeah.
You know, even for somebody in that category, I'll ask a lot of times business owners, what's your largest expense? And they'll say payroll, or they'll say things like that. And I say, you're lying to me. And they're like, well, what do you mean I'm lying to you? I'm like, you're lying. Your biggest expense is tax. And so one of the most effective ways to mitigate tax is using a variety of tools. And one of the tools in somebody's quiver of tax management tools is, I would believe, flow through shares. And I'm wondering if you're listening to this podcast, great. I'm going to walk you through the numbers audibly. But if you're watching online here, and it's available on YouTube, I'm going to share my screen here. I just want to kind of walk you through this really briefly, because I think this is really neat. And I want to quantify, these were tax calculations based on 2025 tax rules. I've yet to have it updated for 2026, but it's pretty clear. And so when the investment dollars goes in, there's certainly, from an investment return standpoint, we already highlighted it, there's some risk. You know, Dan, I think you do a great job of managing that risk, but there is certainly risk to it. There's a non-risk component, and that's how it's treated from a tax standpoint. And so if somebody's at the top marginal tax bracket, I want to highlight something. I threw in $100,000. So if $100,000 goes in, they're going to immediately save the same tax as if it was going into an RSP. So in theory, if they had $100,000 of RSP room at the top marginal tax bracket, they would save $53,000. Why? Because you're at the marginal tax rate of 53%. So if you imagine saving $53,000, it sounds like a pretty good deal. But Dan, there's something else in here that I'm wondering, like, who gives you these things? What are these things, Dan?
Sure. The critical mineral exploration tax credit, CMETC, and the mineral exploration tax credit, METC, are federal investment tax credits. They are basically, they're very powerful in that you can deduct those from your tax payable at the end of the year. And there's also, I don't want to get too in the weeds here, but there's also a lot of flexibility about being able to carry them forward and things like that as well. So it's a very, not only are they significant tax saving numbers, they're also significantly flexible.
Yeah. There's a lifespan on these losses. The lion's share of these losses can be utilized for 20 years, correct?
Yeah. Yeah.
Yeah. So again, I'm not pretending to be your accountant. Dan is not trying to give you accounting advice, but I certainly, from a product knowledge standpoint, I think it's fairly, like, for somebody at the top marginal tax bracket, somebody has the ability, without risk, save $73,000. 73 cents on the dollar. That is unbelievable. So, you know, in this scenario, and again, this certainly applies across the provinces. it's at slightly different rates, but using specifically Ontario as the example, because I'm recording here in Ontario, 26 grand is at risk. So $100,000 goes in, $26,000 is what is the capital at risk after you get your money back. So one of the things I want to highlight is to say that the vast majority of the shares that the funds have been in the positive return profile, Dan. But I think this is really kind of neat. Is in here I've shown an estimated return on the shares of 0, meaning that, Dan, I'm going to pick on you for a moment. Let's just pretend that you do an okay job. And what I mean by that is that, over the 7-year period, you do an okay job and you generate a so-so return, meaning that you didn't lose me any money. So I gave you $100,000, you gave me back $100,000.
Yep.
And so now what's going to happen is I get $100,000, and to make us feel even more frustrated about that, I now have to pay capital gains on that $100,000. Oh, thanks a lot, Ian. But when we factor in the savings on that, the total return on that, dare I say this, the total return on that just from the tax savings alone is 179% total return. That's unfreaking believable over a 7-year period, meaning the maximum time that this capital could be locked up, and usually you get it all the way through, is approximately 25% return annualized. Dan, can you sign me up, please?
We do have documents for that, so yes, you can absolutely be signed up for that. Yeah, the flow through program in Canada is a phenomenal program, and I would just like to highlight for people that it is a deliberate and conscious decision of the governments in Canada and the CRA to put this program in place, specifically because it also helps Canada economically for decades in the future. So we find resources, we find mines, and those things go for multi-decades, providing really good jobs for people, and that's why the governments like it. And the governments are not being particularly benevolent when they create these programs. For them, they see payback all over the place. So it's very helpful for them, but it's also really, really helpful for individual Canadians to get involved in.
I just highlight this for the sake of just discussion. If we were to have a modest return on this, call it a 20% return, total return. All of a sudden you can see the math on this is quite dramatic. Again, that return jumps up to 235% net after tax return. But I also love this saying, though, what if Dan's bad? Okay. Mm-hmm. So now historically you've never lost clients, a catastrophic loss. Mm-hmm. It's possible. Anything's possible. But you're diversifying really well. But let's just say that you somehow tripped out of the gate here and we lost 50% of your money. Mm-hmm. Is that a?
Yep, that's that's not out of the realm of possibility. Yeah.
So the investment does really poorly, and so again, you get 100% of the write-offs. I told you that was not a part of the risk profile, and then you have 50% gone. So you only get 50,000 back, but because we wrote off all of the taxes on the front end, we still now have to pay capital gains on that. Oh man, the return still net after capital gains, $13,000. Sorry, not 30. Sorry, that was the capital gains tax. My apologies. The return on that is still 40%. 40% return. We actually have to kind of start creeping up there where we're seeing even higher losses in order to be in the negative return profile. So all that to share there is to say, Dan, this is a very, very powerful tool, and we really appreciate you providing such a really cool tool for us. Is there anything else you want to add in terms of color on that, Dan?
I would just, I think you've shown it and explained it very, very well. The tax benefits are large and they're ingrained in the tax code, and we're not doing anything, very special there. It's available to everybody. What I see my job is to take care of the portfolios. The tax takes care of itself. It is just inherent in the space that I operate in, and my job is to make as good a portfolio as possible. I don't. It is a risky area. That's why the tax benefits are there. But I believe with a professional running the money with experience, I'm not the only professional in the world or in the country that does this. Or others, but you need professionals in this. If there's one space in investing where you need professionals, I think this is one of those, because it is something that is very knowledge specific. But when you've got that person running the money for you and making calculated risk decisions, that the tax benefits are extraordinarily large, and professionals are able to preserve most of those benefits, or in many cases all of them, and then some return on capital as well, which is what we create the portfolios for to begin with, is return on capital.
And I oftentimes end my podcast with a question of why Pavilion? Why should clients trust you, Dan, with their money? And I think you just categorized it right there. You guys have the history behind you, the skill set. You guys do a great job for our clients, and I look forward to our continued partnership. It's an absolute privilege to work with you, Dan, and I really look forward to working with you in the years ahead. And certainly, if somebody's interested in Pavilion, they can certainly reach out to our office, or they can also search you up on your website. We'll throw your website into the show notes. But certainly, thank you so much for your time today, Dan.
Great, thank you for having me, and I appreciate what we've done together here. This is great.
All right. Until next time, join us at ardillgroup.com, or you can check us out on our next episode on Money Match.